Okay, guys, so we have a potential buying opportunity for gold prices quoted in US dollars. And we have seen gold have a dramatic rise since 2019. And remember, this is because all of the stimulus that's been pumped into the US economy by the central bank and the government, and most importantly, long term bond yields. So the interest paid on government debt has steadily been declining. So investors cannot protect themselves against the risk of inflation by buying safe haven bonds, which is usually the preferred choice of an investment for an investor who just wants to preserve the wealth of their investments or their capital and not lose each dollar or certain amount of value of each dollar due to inflation. So what we can see here from this Excel spreadsheet is that you can see here we have a 10-year bond yield, the interest paid on a 10-year bond yield minus a 2% inflation rate per year. And then you start to see that we've been seeing government 10-year bond yields declining on a structural downtrend going back to since 2008. And every time the bond yield was going lower, gold prices in red are going higher because as the yield is going into a negative territory, so as soon as we get below the level of zero, which basically means investors are not getting paid any interest on their bond investments over the rate of inflation. So basically that their dollars are losing value. Investors have to find an alternative to preserve their wealth. And this is why we have gold prices moving to the upside when bond yields are falling. And it's happened again aggressively this year when bond yields were declining aggressively because of the coronavirus pandemic. Since 2018, it's actually been happening on a downtrend. You've seen gold prices rallying aggressively because investors are now actually losing 1.25% of each dollar they hold because of a negative 10-year bond yield once you take out a 2% expected inflation rate per year. So investors have to protect themselves against the value from their dollars, the value of their dollars. And then we've got now Joe Biden expected to win the election, and he's expected to take the House and the Senate, and he's expected to be able to push a big stimulus bill through the US Congress. And that would mean a lot of spending in the US economy, and that would potentially be very inflationary. So again, if that does ignite inflation, then investors again have to protect themselves against their wealth, and they're doing it by buying stocks and they're doing it by buying gold. So we have seen gold in this range where it was actually declining from the all-time highs it reached this year of over $2,000 an ounce, and it's now declined. But we have now started to see some higher lows forming. So the prices are now pushing back to the upside. But if we can get now a break above this short-term trend line on a technical basis, and we get above this trend line, and we start to see gold prices pushing to the upside, then that will signify that this long-term trend that we've been seeing in gold prices moving higher, as you can clearly see here, going back a while, this should continue. And if you look at the bigger picture, since 2008, when the financial crash happened, gold prices have done nothing but rally higher because all the extra stimulus is inflationary. Bond yields are going lower on government debt because the central bank has to suppress the interest that government pays on its debt because it's now running such a huge deficit in its taxation compared to how much it's spending. And then, of course, they need to be able to borrow at low rates of interest. So the central bank is helping the government borrow at low rates of interest to maintain GDP growth. Once you have a GDP debt, so once you have a debt to GDP ratio over 100%, you have to suppress interest rates. So that's a buying opportunity in gold prices. If we get above this trend line here, we understand the fundamentals driving gold higher because investors can no longer buy a 10-year government bond and protect themselves against inflation because now the bond is not protecting any of their dollar values from inflation in the future. So investors have to look for an alternative to protect their wealth. So they're going to buy gold, and that will obviously protect themselves. So let's say inflation is 2%, and you're losing, say, 1.25% if you buy a bond yield. But if gold goes up by 60% in a year, then you've more than protected the wealth of your investments. If you're in the stock markets, for an example, or if you're just sitting on cash, you want to preserve the wealth of that cash. So Gold in 2020 is up so far 30%. So then you get a bigger picture to understand that gold is a good hedge against the devaluation of money due to inflation and huge amounts of stimulus being pumped into the economy. So I hope that makes sense, guys. A strong break above the trend line. That's a good buy. And that's the fundamentals behind gold prices potentially moving higher over the long term.